So I'd like to introduce Rachel Adetitun, an amazing lady. We actually met quite a number of years ago, actually, when Black Economics first started having meetings. And the meetings actually started in my home. And she reminded me the other day that, we came to your house and you cooked us dinner. I thought, oh my goodness. Back in the day, we could fit everybody in the house, So she comes as a professional estate planner. Her business is ashtongrace.co.uk. She has said that after the event today, if you want to arrange a 15-minute private consultancy with her, she will provide that at no cost. So bear that in mind. We will put her details over in the chat as well, and she will probably share some information about how you can contact her as well during her talk. But I did hear her do something similar to this when we were meeting back in the smaller groups when we first met, and it was amazing. The content is really fantastic, and I know that you will be blown away tonight. So Rachel, thank you very much for agreeing to do this. This is something really that everybody needs to know, and regardless of how many people are with us tonight, we will make it available so that as many people as possible can see it and start really planning for what's going to happen after they're gone, because unfortunately we're not here forever. Although we'd like to be, we're not. And some of the English people have this down to a pat where they're really good at planning their estates, but we're not. There's too many of our parents or family who have gone, left no wills, and then the estate is a mess. Sometimes people who are supposed to get things don't get it because the person who has departed, although they would have liked maybe the son or the nephew or the niece or a friend to get part of their estate, they didn't write it down. So we need to, as a community, get out of the habit of just sort of leaving things to the last minute, thinking that we'll have time, because we just never know really what could happen around the corner. And for our family, for our parents, our older generation also, this is information that we can share and give to other people. So Rachel, I'm going to hand over to you. Thank you so much for being here, and enjoy your evening, everyone.
Thank you, Dawn. Thank you, everybody. Shall I share my screen? All right, bear with me because I am not tech savvy. I will do my best. Here we go. Share. Lovely. I think that's it. I will say, first of all, I'm so pleased I kind of let you see my face before Dawn pressed record, because I'm not internet ready to have my face blasted on YouTube and have the wrong light and everything else. So I appreciate the heads up, Dawn. Hello, everybody. So welcome, everybody. Dawn, thank you for asking me to actually do this webinar. It's really my pleasure to do it. I share this information daily. I've done quite a few presentations, and I really do love sharing it amongst the Black community, because I just think there's a general lack of knowledge there. So anything I can do to improve that, I will seize the opportunity on most occasions. So I'm going to be very succinct, but try to be very thorough as well and efficient, because there's quite a bit that I want to get through, and I hope that you will find, in fact, I'm sure that you will find it valuable. So I don't want to waste any unnecessary time. This topic is planning for the future and beyond, and it's wills and estate planning, which does tie up with legacy planning as well. So like Dawn said, this is my business is Ashton Grace, and I specialise in will writing and estate planning. I do have to throw out some obligatory disclaimers and a little bit of housekeeping as well. The last 15 minutes, I hope, it will be available for Q&A. So if you have any questions, please feel free to ask, and depending on what time I finish, I will happily answer those for you. But like Dawn mentioned, there is an opportunity for you to have a 15-minute complimentary call with me, just to answer any questions that you may have. And the reason I may not be able to answer all questions is because I too have a little one, just like I think it was Lila who said. We heard them in the background, and I don't know if she'll kick off after 8. So no, it's all dependent on her schedule and her feelings. So with regards to this presentation, the content is based on Ashton Grace's understanding and interpretation of current legislation. If any questions are asked, it will be general advice or guidance that will be given in response to any questions. It will not constitute personal legal advice. Any advice or guidance that we do provide to clients would be bespoke and based upon their personal circumstances, okay? So none of you are going to sue me, okay? It's just general advice that I'll be giving in response to any questions you ask in this platform, should we say. All right, so I am Rachel Adetitun. I'll be delivering the presentation. I'm a legal consultant. My business is Ashton Grace. I specialise in wills and estate planning. So that's really wills, trusts, inheritance tax advice, assistance of estate administration, funeral plans, etc., things to do with making sure before you have passed away, you have the right things in place so that your family can be provided for as quickly and as tax efficiently as possible. I've had my business for over 10 years. I think it's about 11 years now, or just over, and I've helped well over 1,000 individuals get their affairs in order. With regards to today, this is the agenda. I'm going to talk to you about estate planning, first of all, explain what it is, talk about inheritance and the racial wealth gap, because unfortunately race does come into it, and provide an overview on inheritance tax. Then I'm going to move into making a will and things that you should think about, the key considerations when it comes to that, and common problems and circumstances that come up and maybe prevent people from making a will or delay them from doing that. I'll talk about the impact of dying without a will, and then I'll talk about lasting powers of attorney. But to be clear, the bulk of this will be to do with wills and why they're so important. So I probably will squeeze through and rush through lasting powers of attorney, even though they are important, just because for most people, certainly within the Black community, based on my experience, there's just not even a will in place. And so for me, that's my utmost attention. I'll give my utmost attention to that at this time. And then I'll give you details on how you can get in touch, okay? Whew, okay, so estate planning. And I was going to say, if you do have any questions, just pop them into the chat. I don't know if I'll come out of the screen, sharing my screen effectively, but I'm hoping that if any questions do come up, Dawn can share them with me, or then maybe you can just book a consultation if we don't get enough time. All right, so estate planning, what is it? Because that really is a phrase that I find is more familiar or has more common parlance in the States. Broadly speaking, estate planning involves maximising wealth and then passing it on efficiently. So really it's about accumulating wealth during your lifetime, and then making sure when you transfer it, you're not reducing the value of that wealth by missing out on opportunities to take advantage of, you know, allowances and exemptions that may be available to you and various other things. Concerning estate planning, generally there are two aims. The first is that you want to, the aim from my point of view is that, and for the individual, is that financial security wants to be utmost in people's minds so that they are financially secure and also their loved ones are financially secure, number one. Number two is to reduce tax liabilities. Where there's a conflict with regards to creating financial security for yourself or your family or reducing your tax liabilities, financial security should always be paramount, okay? So if you can't achieve both, then certainly you should achieve financial security for yourself, because if you were struggling, then you're going to be of no use, then that hampers or will have an impact on how you're able to provide financial security for your loved ones. When I'm speaking about reducing tax liabilities, for this presentation, I'm really talking about reducing tax liabilities with regards to inheritance tax. And that's because this presentation will focus on transferring wealth on death. For some people, depending on the value of their estate, it may be that they need to make transfers during their lifetime, okay? So they know that they've got an inheritance tax liability on the horizon, let's say. They know they're not going to spend all of their wealth before they pass away. So they want to start reducing their wealth now. And so in those instances, there'd also be an interplay of income tax that we need to consider in capital gains tax, but that's not necessarily the case when you're just looking at transfers that are made on death, because only inheritance tax will apply in the main. And just so you know, married couples with children and possibly grandchildren offer the greatest scope for estate planning. And what that simply means is if you're married with children and grandchildren, then you are in the best position with regards to allowances and exemptions that may exist to pass on as much of your wealth as possible. And this is just to let you know as well, if I mention married couples, that applies simultaneously to civil partnerships, same-sex marriage and same-sex civil partnerships. The law regards them all as the same. So I'll be saying married couples and spouses, but that applies to all the other references I've just mentioned as well. Okay, so let's talk first of all about inheritance, estate planning, inheritance and the racial wealth group. So this is really important to me as a Black British woman of Black African descent, particularly because I'm Nigerian. You know, how does inheritance and the racial wealth gap exist or work together? And when I speak about the racial wealth gap, it's just generally with regards to different ethnicities, where do they sit in terms of household wealth, median wealth, wealth that is transferred on death. And we know, or we certainly should know, that there's a really big disparity between, let's say, a white British individual and somebody of Black descent. There's going to be a difference in their wealth. And a lot of times it's because of ethnicity and other things that come into play. So let me just read this part out. Inheritance. So this was from the press release from the Resolution Foundation in December 2020, and they were looking at wealth and a few other things. And they said in this report that inheritance will also play a part in prolonging these wealth gaps. So that means at the moment, racially, Black people aren't in the same position as other races when it comes to wealth. And their analysis showed that over the past 2 years, the average person of white British ethnicity inherited a total of £3,068 from friends and family, which was almost 50% more than an average person from the next highest inheriting ethnic group, people of Indian ethnicity, at £1,958. The average person of Black Caribbean ethnicity inherited £778, while those of Black African, Chinese, Bangladeshi or Pakistani ethnicity typically inherited nothing. So let that sink in. We're talking about averages along ethnic lines. And in the UK, people of white British ethnicity inherited the largest amount, on average at around £3,000. And at the bottom, let's say, or close to the bottom, we have Black Caribbeans who are inheriting on average £778, and Black Africans, and I'm pulling out those two because this is Black economics, who on average inherited nothing. Okay, so just bear that in mind. This is the importance of estate planning. And I say that because, moving over to my next slide, I actually, through my work and personally, know how receiving an inheritance has positively impacted a lot of people, which ultimately would have a tipping effect on the racial wealth gap. Okay, so for people who have received an inheritance, and I'm not talking about hundreds of thousands, sometimes I'm talking about tens of thousands here, sometimes I'm talking about hundreds of thousands, but it has impacted the life of the beneficiary such that it has enabled them to purchase new cars. Okay, I knew a lady at my workplace years ago who, she was 21, her grandmother had left her something in her will, left her a legacy, which enabled her to, at 21, think about, I'm going to buy a Mini Cooper. She didn't have to worry about putting down a deposit. She wasn't using up all of the inheritance. And I think there would have been something there left over to maybe put a deposit on a house. How lovely would it be as a 21-year-old to receive that kind of money left by your family who've passed away to know that you can buy a car, maybe put down a deposit on a home. I've had people experience clients who've received an inheritance. It has enabled them to put down a deposit for a home purchase, or to clear outstanding mortgage balances, or to provide a savings cushion that perhaps they never had previously, or to increase their pension or savings contributions. Just imagine how impactful that would be on your life just because somebody has left you an inheritance. These things and more have an impact on the racial wealth gap, okay? And think of that, bearing in mind that if you are a Black African, statistically, it's saying on average, you are not likely to inherit anything. And if you're a Black Caribbean, statistically, on average, you would inherit around £800. Okay, so obviously we know there are people who will inherit more than that, and there'll be people who inherit less than that if you can inherit less than nothing. But bear that in mind, this is the importance of estate planning. Okay, and the knock-on effect of having received an inheritance tax, practically and emotionally, that I have seen, is that these individuals see the value in making a will for their loved ones. So just that they have been able to be positively impacted, they now are quite happy to roll over and make a will and receive estate planning advice because it's benefited them. What I find within the Black community is that there can be, and I'm saying this very generally, okay, this doesn't apply to everybody, but I know that certainly my experience sometimes with a lot of the older generation is that perhaps there's a reluctance to make a will because for superstitious reasons, they think they're tempting fate, or for cultural reasons. And what that does, it can just leave problems, or it can just leave loved ones in difficulty because they don't have financial help when they could have received it if somebody had made a will. Okay, so let's get down to the nitty gritty. I want to talk about inheritance tax. What is it? So inheritance tax is a tax that is paid upon the estate of somebody who has died. It does not apply to all estates, and every estate must be considered separately to identify its taxable position. Now, when I say estate, I'm talking about the stuff that you own when you pass away. It will be your personal possessions, your property, your savings, money you've got in a savings account, ISAs. It will be life insurances if they're not written in trust. It will be your buy-to-let portfolio, whatever it may be, whatever things that you own in your sole name, or if there's property, whatever's owned in your sole name or as a tenant in common, perhaps not a joint ownership property, depending on how that property is owned, but generally things that you own. And it's a tax that may or may not be paid on the value of your estate, depending on the value that it's depending on how much it's worth. Okay, so inheritance tax is paid on estates which exceed the value of the nil rate band available to the deceased. Everybody has a nil rate band, so this is universal within the UK, of £325,000. So how that works in practice is inheritance tax is applied to your net estate. So that's the value of your estate after all your expenses have been paid. So after your mortgage has been cleared and the mortgage company paid back any debts and liabilities you have, funeral expenses, testamentary expenses, what remains is the amount that is assessed for inheritance tax. So let's say an individual has an estate that's worth £325,000. Now let's call it £425,000. The first £325,000 value will be taxed at 0%, hence the nil rate band. Okay, anything above £325,000 would normally be taxed at around 40%. So an individual with an estate worth around £425,000 after all the liabilities have been paid, the first £325,000 of that estate will be taxed at 0%. The balance of 100,000 would be taxed at 40%, which means £40,000 would be due to revenue and customs. And then the remaining amount, £385,000, would be distributed according to the terms of that individual's will, or if there was no will, according to the rules of intestacy, which I hope to get onto. Some common exemptions which exist for you to be familiar with. If you are married, and this goes back to your best place to take advantage of any allowances and exemptions that exist if you're married and perhaps have children or grandchildren. If you are married, anything you leave to your spouse, they will inherit tax-free. So in that exact same example, an individual passes away, they're worth £425,000. That's the value of their net estate. If in their will they've left everything to their spouse will receive that full value, £425,000, without any deduction for tax, because they have exempt status. Okay, so they're an exempt class, no tax will be due. All right. Similarly, if you leave a gift to charity, whatever you leave to charity will be tax-free. So an individual whose estate is worth £425,000, they leave everything they have to different charities, UK registered, no inheritance tax will be due because the charities have exempt status as well. Okay. The following must also be borne in mind when considering the nil rate band available to each estate. So in calculating the value of somebody's estate, you don't just go on what the value is at the time that they pass away. You also have to see whether that individual made any gifts during their lifetime. I'm not going to go into gifts because that's almost another topic within inheritance tax. But if they have given away gifts, if these aren't part of the exempted gifts, and depending on when they were given away, it may be that you have to include that value in the estate for inheritance tax purposes. And the same also applies to trust created during that individual's lifetime. So if the deceased person gifted property into trust, or savings, or any type of capital or financial assets into trust, we would need to see, in working out whether there's any inheritance tax due on that person's estate, when those gifts were made, when those transfers were made into those trusts, and also whether the deceased could benefit from those trusts as well. And that could have an impact on how much of the nil rate band is available to the deceased person when they pass away. You also have to bear in mind what's called the transferable nil rate band and whether that's available. This goes back to a spouse. So in the example I gave where I spoke about common exemptions, if you leave everything to, if a spouse dies and in their will, or by other means, everything is inherited by the surviving spouse, when the second spouse dies, their estate will have available to them that deceased spouse's nil rate band, which is £325,000, but the executors can also claim the nil rate band of the first spouse who died. Okay, so that's also £325,000 at today's figures. What that means is inheritance tax would only be due on the estate of the second spouse who died if the value exceeded £650,000 based on the current nil rate band figures. So you would have the allowance or the nil rate band of the first spouse who died, and you'd also be able to add that to the nil rate band allowance of the second spouse who died if they received everything from the first spouse. So no inheritance tax would be due if the estate was below £650,000, okay? All right, so I've spoken about inheritance tax and how you pay a rate of 40% if you exceed the nil rate band, bearing in mind those common exemptions that we spoke about and taking into account whether any gifts have been made previously and a few other things. If you, but there's also something else, if you were to leave 10% or more of your estate to charity, and excuse me, if you were to leave more than 10% of your estate to charity, if inheritance tax did become due on your estate, then the rate of inheritance would drop from 40% down to 36%. Okay, so just worth bearing in mind. And then finally, I want to speak to you about the residence nil rate band. I'm not going to go into too much detail. In fact, I'll just read through this and explain. This is an additional nil rate band which can be applied for when a property forms part of the estate. So if you own property, it may be that the residential nil rate band would also apply, which is an additional allowance. The residential nil rate band is subject to specific rules set out by Revenue and Customs, HMRC, which we can consider when ascertaining the IHT position, the inheritance tax position of the estate. Generally speaking, the specific rules are A, that you're married. See what I mean about married couples? A, that you're married. B, that you own a property that you have lived in. And C, that you have children or direct descendants. And these can be stepchildren, foster children, adopted children. If you qualify, if you fulfill those criteria, generally speaking, you may be able to benefit from the residential nil rate band, and that essentially gives you an additional, or your estate an additional £175,000 tax-free allowance. So rather than your estate benefiting from £325,000, which is the nil rate band, which applies to everybody, if you qualify for the residential nil rate band, you get an uplift of £175,000, which means potentially no inheritance tax would be due on your estate when you pass away if it was below £500,000, because 325,000 plus 175,000 is £500,000. And this residential nil rate band is transferable in the same way that anything you leave to your spouse, let's say you leave all of your estate to your spouse, it's like you didn't use your allowance, and then your spouse's executors can claim that allowance from the estate of the first spouse who died. This also applies for the residential nil rate band, okay? So it may also be possible to claim the transferable nil rate band allowance. Any part of the estate which passes to a charity or to a spouse is exempt from inheritance tax, as I've explained. And to summarise, it would be necessary to consider all of the above and everything I explained previously on the other slides when ascertaining the inheritance tax position of the estate. So let's look, this is a summary now of how the allowances work. The nil rate band. The nil rate band is currently £325,000. It used to go up every year. It's been at this rate for a long time now, and it attracts a charge of 0%. For married couples, on second death, you can claim the deceased person's allowance, so the spouse who's just died, plus the previous deceased spouse's unused allowance. So, for example, if on first death everything went to the surviving spouse, then 100% of the allowance of the first person to die can be claimed, which would currently be another £325,000. However, if some was given elsewhere on first death, so if the first spouse who died gave some of his estate to his children or her children, may left the legacy to the kids, then only the remaining amount of the nil rate band can be claimed. It is calculated as the percentage given and the percentage left, but not the actual amount, as the nil rate band changes over time. To give you some examples of that, and this is examples of if you don't leave the entirety of your estate to your spouse if you're married. I've set out some examples here. So let's say a husband dies in June 2017 when the nil rate band was £325,000. He gave £65,000 to a child as a legacy in his will, and everything else went to the spouse. £65,000 is 20% of the nil rate band, which is £325,000 currently. So 80% from the husband's death would be available to be claimed. Okay, so that would be an additional £260,000, which essentially means when the wife passes away, she will have her nil rate band, which is currently £325,000, and then she'll also have 80% of whatever the existing nil rate band is. If we assume that is still, the nil rate band is £325,000, then we can assume that on the death of the second spouse, they would have £325,000 available plus £260,000 available, which would be so it'd be around £600,000, roughly speaking, that would be available to the estate of the second spouse when they die, not just £325,000, okay? Second example would be, let's say it's now the wife who dies. She passes away in June 2002 when the nil rate band was £250,000. Okay, so it wasn't 325 then, it was 250. Same sets of facts, £65,000 was given by the wife to her child as a legacy in the will, and everything else went to the spouse. £65,000 is 26% of £250,000. So only 74% from the first death can be claimed, i.e. another £240,000. And the point that I'm making here is that it's a percentage amount. So we don't have to worry about the exact amount. Well, we need to know the exact amount that may be left as a gift to somebody else who's not a spouse or an exempt class. But we need to know so that we can work out the percentage amount so that we know how much can be added, if at all, to the estate of the second spouse when they pass away. All right, so that's really all I wanted to say about inheritance tax. There is more to it. There's a whole section I could do on gifts, which I'd be happy to go through if we have a chat. I don't think it's necessarily relevant right now, but gifts are a way of just reducing the value of your estate, provided you make a legitimate gift and you don't continue to enjoy it. All right, so that moves me on to, very nicely, why it's really important to make a will and the key considerations. So when somebody comes to talk to me about making a will, these are generally the things I ask them to think about. For parents or legal guardians who are responsible for children under the age of 18, a crucial consideration is who would you appoint as guardians. It's as simple as that. If something was to happen to you, the will is the place, and for most people, where you would stipulate who would have responsibility for raising your children. So a will is important in that regard and is a key consideration. One of the next things to consider is choice of beneficiaries. So when you pass away, who is to inherit your estate in the first, second, and third instance? In my experience, married couples and unmarried couples will often say, if I pass away, everything should go to my spouse or to my partner. If they've passed away, then everything should go to my or our children equally, if there's more than one. And then I ask them to think about another tier as well, because if you've gone to the trouble of making a will, and if you've got a young family and you live under the same roof, it's worthwhile having somebody else who would stand to inherit the estate if tragically something happened to all of you. Distribution of your estate is really talking about the amounts that somebody is going to receive. So I mentioned for couples, oftentimes they'll say everything to my spouse or to my partner. So on first death, when one of them passes away, the estate will be inherited 100% by the surviving spouse or partner. When that surviving spouse or partner passes away, often they'll say everything to my child if there's one, 100%, or in equal shares if there's more than one. So the distribution will be 100%, or whatever, if there's 4 children, 25% each. So that's the distribution I'm thinking of. For single people, I find oftentimes that with them, they will make provision for, in the first instance, if they're not in a relationship, and if they don't have children, so I'm not talking about people who have children, It will often be for close, it will often be charities, siblings, nieces and nephews. It doesn't have to be, but that's what I find often comes up, and parents as well, if the parents are still alive. Another key consideration is the role of executor, and this is really important because the executor really will be responsible for making sure ultimately that your beneficiaries receive whatever remains of your estate once they've gone through the estate administration process. So you want people who are trustworthy, who are good at administration, because we call it the executor's year, and it can take about a year on average for an estate to be administered from beginning to end, because there are various things involved and there are legal and financial responsibilities included in there as well. So it's really important to think long and hard about who you want to make as an executor. Common choices would be a spouse or a partner, siblings, anyone who has an accountant or a solicitor or somebody in a legal profession as a close friend or a family member. They always get appointed whether they know it or not, because yeah, this person will be great at it, and that's often quite a good choice. But it doesn't have to be somebody legal, it doesn't have to be somebody who's an accountant, just somebody who can get the job done or would know to reach out to others if they were struggling to get the job done themselves. Also, you need to think about legacies within your will. Not very popular, but sometimes people make gifts, a monetary sum, give a monetary amount to godchildren, to grandchildren, £10,000 to my granddaughters, to nieces and nephews. It would depend on a variety of things, the value of your estate, how much you're leaving, and who your beneficiaries are. I find that where couples have children, perhaps, or an individual has children, there's less consideration given to making separate gifts. And then you need to think about the value of your estate for inheritance tax purposes. So I always ask people to have an idea of roughly how much they're worth. If they own property, roughly what's the value of the property? Just check on Rightmove. If there's a mortgage outstanding, what's the amount? Do they have any life insurance? How much money do they have in savings and investments? And this information doesn't go into the will. It's so we can have a sit down and I can explain to you how inheritance tax works and how it would apply to your estate. And we can look to see whether there are any allowances or exemptions that would reduce or mitigate the amount of inheritance tax that could be due on your estate. So common problems or circumstances that I come across that will often cause people to delay making their wills or not make them at all if they fall into one or more of these categories. One of them I will say, because I'm speaking to Black economics, is sometimes there's a reluctance because of cultural beliefs and superstitious beliefs and religious beliefs as well, okay? And that will often, unfortunately, cause people to not make a will, which can be problematic for the people that they leave behind. Another circumstance is what's called blended families, and that may be where you have stepchildren, or it may be where you are in a relationship currently with somebody who's your spouse or your partner, but they are not the parent of your children. So you have children from a previous relationship, or your partner or your spouse does. And so the concern here is, how do I provide for my spouse or partner alongside my children? Another circumstance might be single parent household. And here the issue oftentimes is, I think that comes up, might be guardianship, who's going to raise my children? I perhaps maybe don't want my partner to be responsible for them, and who would benefit from my estate after my child has passed away. And a big one is estranged family members. And so this is where people have fallen out with parents or children or wider family members, and their concern is, actually, I just want to make sure this individual does not receive anything from my estate. And so because they have these, what you have to understand about wills is, apart from COVID making everyone rethink the importance of making a will is oftentimes on people's to-do list, and they may never just get around to doing it, or it's something that they understand that they need to do, but they don't know where to start and they're quite overwhelmed by it all. If you add into the mixed blended families and estranged family relationships, it can make it even harder to do. And so all I'm here to say really is that it is possible, regardless of your circumstance, whether it's fairly straightforward and everybody in your family gets on fine and everything's great, or whether it's quite a problematic one for you to think about, there is a solution that can be created under your will. And I would suggest that it's normally to do with trust wills, and that's a way that would allow you to secure, almost guarantee, the preservation of some or all of your estate for your kids or your chosen beneficiaries, regardless of whether one of your beneficiaries passed away. Okay, so if we talk about, if we consider perhaps an example where there may be children from a previous relationship, You might be somebody who's in a relationship with someone right now, and they're not the parent, the mother or father of your child, and you want to provide for both them and your kids, and you don't know how to do it. A trust will be something that would most likely help you, because it's a way to preserve assets for your children while making provision for your spouse or partner, such that even if your spouse or partner was to go on and later remarry, or to have more children, your children that you have, whether with them or somebody else, would be protected and provided for, or rather their inheritance and their funds would be. So that would be a trustable solution. The point that I'm making here is there's almost a solution for every scenario. There's no reason that you shouldn't have a will, because there's something that can be given, there's a solution that can give effect to your wishes, so that all of your loved ones are provided for, or so that you can, as much as possible, keep, people's hands off your wealth if it's not your intention for them to benefit from your estate. Okay, and that, of course, leads me very nicely into dying without a valid will. And the reason why I've said it's a valid will is because once you make a will, that's perfect and that's great, but you need to make sure it's been executed properly, and you need to make sure you've allowed scope for, if your first choice of beneficiaries, let's say, have passed away, there's still somebody who's going to inherit. So, you might have somebody who's made a will and there's only one beneficiary. If that beneficiary dies, they don't have a valid will anymore, because there's nobody named to be able to benefit from their estate. All right, so the implications of dying without having a valid will are that the family courts will determine who has legal responsibility of your children. And as a parent, I know that is literally some people's worst nightmare, just to think about it. A will is a place for you to decide who's going to raise your children, and it's something you need to think about and not leave to somebody else because it's too difficult for you to think about, because the family courts may place your children with somebody you wouldn't have chosen because they don't have that relationship, or maybe they don't have the means. So, I always say making a will isn't about you, it's about the people you leave behind. So just if you have children, it's important to make a will just for that. Let's forget the financial assets. Your children are your main assets, as it were, in terms of love and emotion, etc. A will is a place to show that you cared, because you thought about, if anything should happen to you, God forbid, who's going to raise them. All right, moving on to assets. If you have not made a will, then the rule, or if you don't have a valid will, the rules of intestacy will apply. And I'll call this the government will in inverted commas, because it's essentially predetermined government rules that set out who your beneficiaries and who your executors are. And there's this misconception that a spouse will automatically inherit everything. And there's also this misconception that if you live with somebody as your common law spouse, which isn't recognised when it comes to succession law, they stand to inherit as well. And that's just not true. Your spouse may inherit everything, but it would depend on the value of your estate and whether you have children. And if you are not married, your common law spouse, as it's referred to, wouldn't receive anything, because they are not included for consideration under the rules of intestacy. So I could go into it. The point here is, if you don't make a will and something happens to you, the state will determine who your beneficiaries are, and that order will be followed. And if anybody feels that they have an entitlement to your estate, they will have to make a claim. Okay. Added to that, the estate administration process is more convoluted. So I mentioned that on average, we call it the executor's year. When somebody passes away, and that's even if they have a will, and obviously it would be dependent on the assets that they have and the size of their estate. But, somebody who has got assets and they pass away without a will, it potentially can take a lot longer than that, double, triple that time, because the process is more convoluted. And also I find that the estate is more susceptible to claims. So it's almost like somebody's passed away, there's no will. We all know that money can sometimes bring out the worst in people, and they will act on this and they'll make a claim against the estate. Whether they have any grounds to do so is almost neither here nor there, because it will need to be looked on, and that will delay the estate administration process. Okay. Added to that, greater inheritance tax could become due on your estate. Hello. Greater inheritance tax may fall due on your estate in the absence of a will. So I spoke about, for example, if you're married, someone I think needs to mute. There we go. I've spoken before on the fact that there are allowances and exemptions that exist for you that you can benefit from. They're almost scuppered if you don't make a will. Okay, it could mean that when one of you passes away, estate tax is due, and this can be avoided by just making a will. So dying without a will is just, it should be avoided at all costs. And this, I would say, even if the estate is quite small, I know of people personally and through obviously my line of work where a parent has passed away unexpectedly, and you know, they may not have had a lot of money, they may not have even owned property, but they had some money in the bank, but they never had a will. And so because of that, the banks are reluctant or refuse to give the money to the next of kin, who might be, you know, children, for example, a few £100s, a few £1,000s. However, it's not worth the cost of applying for the grant of probate, which is part of the estate administration process, to release that money. So the end result is that few £100s that's sitting in the bank that maybe could have benefited a child or children of the deceased parent, they can't even get hold of because they never made a will, and the cost to get the document to release the money from the bank is greater than the funds that are in the bank. Okay, so there really is just no, for most people, there's no reason why you shouldn't make a will. Okay, all right, lovely, that's it. How are we doing for time? Okay, not too bad. All right, so that now brings me on to lasting powers of attorney. But before I do, let me just summarize, because I know I've spoken a great deal and at length. Let me just summarize the points being made here. And the point being made is that estate planning is about making sure your wealth that you have accumulated during your lifetime is transferred to your loved ones as quickly as possible and as tax efficiently as possible. And that is achieved through making a will. All right. If you don't make a will, the state will determine who your beneficiaries are, and it could mean that you pay more inheritance tax, and it could mean that, well, it would mean that they would determine who has responsibility for your children if they are under the age of 18. If you are married with children and grandchildren, then you are in the best position to take advantage of allowances and exemptions that apply. Okay, there is no recognition of common law spouse. So if you are married, there's no recognition for your unmarried partner, which means if you were to pass away, they would not inherit anything under the rules of intestacy, and the only way they would be able to do so would be to make a claim at court, and they'd need to show various things in order to be successful. With regards to inheritance tax, we all have what's called the universal nil rate band, an inheritance tax threshold, which currently sits at about exactly £325,000. If your estate is worth less than £325,000 net, no inheritance tax will be due. If your estate is greater in value than £325,000, then tax at a rate of 40% will apply. However, if you leave some of your estate to charity, or that anything you leave to charity will be tax-free. And if you leave more than 10% of your estate to charity, any inheritance tax that is due on your estate will be taxed at 36% instead of 40%. If you are married and under your will you leave everything to your spouse, regardless of the value of your estate, so you could be worth £1 million, if it goes to your spouse under your will, they will receive that full £1 million without any tax deduction for inheritance tax. In addition, when the second spouse passes away, they will have available to them their nil rate band, which is currently £325,000, plus a nil rate band, which is unused by the first spouse who died, that can be transferred to them too. So that inheritance tax would only be due now on what would be the joint estate if the estate exceeded more than £650,000 in value. There's a new allowance, well, the last few years, called the residence nil rate band. This is not universal. You have to fulfill qualifying criteria. But if you do, as an individual, your estate can potentially be transferred tax-free up to £500,000. And that might go up to £1 million if you are married and your spouse left everything to you, or you left everything to them and they also had an interest in property. Okay, and I think that's all I wanted to say with regards to inheritance tax. Suffice to say that it's important to make it Black people, Black Caribbeans and Black Africans are at the lower rungs in terms of the amount that they receive in inheritance. And we have seen how just receiving an inheritance can put loved ones in a better position financially, so that they're almost a step ahead than perhaps maybe you were. And it gives them you know, petrol in the station to compete with others or on the wealth stage, as it were. Okay, we're talking about generational wealth. Finally, I want to talk about lasting powers of attorney. A lot of people don't know what these are, but these are essentially documents that would allow you to choose somebody to act on your behalf if you were to lose mental capacity. If you lost your mental capacity and you didn't have lasting powers of attorney, the state can take control of your affairs by appointing a deputy, and the deputy would make decisions for you on your behalf. If you make lasting powers of attorney, it gives your attorneys, and the word attorney, don't let it throw you. It doesn't have to be anybody legal. It just needs to be somebody who's over 18 and somebody that you love and trust and who you know would act in your best interests. It would enable them to make decisions about your property and your money. So transfer money between your accounts, pay, draw down on your pensions, pay your bills, manage any properties you may have. Or it would enable them to make decisions about your health and welfare. And this would be life-sustaining treatment. This would be having the power to speak to your doctors, social workers, care workers on your behalf. And the lasting powers of attorney have to be registered with the Office of the Public Guardian before they can be used. I mean, I've spoken about that really fast, but the point is, if you lose mental capacity and you don't have lasting powers of attorney, the government can step in and appoint deputies. While your family can also apply to be deputies, the powers that they have aren't as wide and far-reaching as the lasting powers of attorney. And the reason why that's important for estate planning is it just means that your money won't be dwindled, because it's expensive to have a court-appointed deputy. There are fees that are incurred and there are court applications that need to be made. And it just means that you've got somebody you love and trust making decisions for you concerning your money, okay, and also making decisions for you concerning your health and your welfare. All right, so last but not least, get in touch. So I've included a link here. I'm offering a complimentary 15-minute call. My diary, I think, is pretty booked up for the first couple of, this week and next week. It's open to you for the whole of June. You don't have to have the appointment in June, but you certainly do have to book it in order to be able to benefit from that call. And you can just, if you've got questions, feel free to ask me. You can also call in and take my details and I'll get back to you. Or you can message me on Facebook. So there's my Facebook, what are they called? Links, I guess. I don't really know. I'm not au fait with that stuff. Send me a message and I'll be happy to connect. And I think that is it. Any questions? Dawn, I mean, I don't know what to do. How was this? That's it. Okay, I hope that was helpful. I'm sure there was some stuff in there that you didn't know and you'll just...
Yeah, definitely. Yeah. It was really helpful. Thank you so much.
My pleasure. So if anybody has any questions, happy to answer them now. But you've also got my details as well, so whatever works for you. Hello?
Any questions, everyone?
Hello.
Hello.
Yes, I just have one question. The lasting power of attorney, is that any different to a regular power of attorney? Is this just specifically for health or for anything? It covers every single thing?
Okay, so there are two, it's different from are you talking about a general power of attorney?
Yes.
All right, so with general powers of attorney, they normally are time or event specific. So often somebody will create them because, and it will be to do with property and money. So usually they might be created when somebody's going to be out of the country and they want somebody to complete a transaction on their behalf while they're away. So an individual might be going abroad and they might be in the middle of a property purchase. They create a general power of attorney, giving their spouse, their business partner, their friend the power to complete the property purchase on their behalf. And once that purchase is completed or that event has taken place, the general power of attorney ceases. Okay, this is different from a lasting power of attorney and also an enduring power of attorney, because the enduring power of attorney, I can't remember, either applied to one or the other. Okay. Property and financial affairs or health and welfare, but not both. Lasting powers of attorney have replaced the enduring power and are different from the general power, but they apply across two areas. And as an individual, you can create them for one area or both areas. And those two areas are either health and welfare. So you create them and it enables people you love and trust, your husband, your partner, your children, adult children, to make decisions about your health and welfare if you lack mental capacity. So it would enable them to be able to speak to your doctors, determine whether you live at home or elsewhere, the care that you receive, taking you on holiday, who can visit you, your exercise, etc. The second area that's covered would be property and money. And this would enable your attorneys to be able to deal with your banking and deal with your property. So they'd be able to write checks on your behalf. They'd be able to pay bills on your behalf, draw down on pensions, manage your property, sell your property even. You can put restrictions and a few other things in there, but that's essentially the scope of them. And the key really is just to make sure it's people that you love and trust, so that you know that they will be acting in your best interest, which they are required to do, should you not have the capacity to make decisions for yourself.
Okay, thank you.
You're welcome.
Can I just ask, Rachel, would it be possible, say say I was to pass away, but my children say my daughter has, we have a joint bank account.
Okay.
So she has access to my bank accounts. So if I were to pass away, she would still have, she would still be able to, you know, take money out of the account though, wouldn't she? I wouldn't.
Absolutely. So with joint property, all right, so I mentioned very, very quickly, but I was mentioning there's essentially two ways that you can hold property, either in your sole name or in joint names. And where you have joint property, there's usually the rule of survivorship.
Right.
You're looking at bank accounts and we're looking at property, but it would depend on how you own it as joint tenants, but I digress. So the rule of survivorship essentially means when one of you passes away, the other joint owner automatically by law rolls over to take over that asset. So
Okay.
It will be in their estate. Now, for estate administration purposes, it may be that part of the bank account is still, half of it will just be assumed to be yours, that for valuation purposes. So if you had a savings account jointly with your daughter and it was £10,000, while she would roll over to then own that bank account in her sole name when you pass away, for estate administration purposes, £5,000 of that account will be attributed to belonging to you, and that would be added to the value of your estate. Okay.
Oh, okay. Wow. Okay.
I know. Yeah. Yeah. So that's how, and the same would apply for property. So you could own a property with your spouse, your brother, your sister, and you own them jointly as joint tenants, not tenants in common. A spouse passes away, the husband or wife then becomes the sole owner of that property. So it's going to be distributed according to the terms of the surviving spouse's will, if they have one. But for estate administration purposes, half the value of that property will be included in the estate of the deceased. So if the property was worth £400,000, even though the surviving wife now owns the entirety of the asset, for inheritance tax purposes, £200,000 value will be attributed to your estate valuation plus whatever other assets you own as well.
So that would mean that, say, on my death, my daughter wanted to sell the property, she wouldn't be able to sell the property because it would be a percentage of that would still be seen as my estate.
No, she would still, as a sole owner, she would be able to do with it as she wishes. So it belonged to her. But in terms of the executors dealing with the administration of yours, so when somebody passes away, Revenue and Custom wants to know what they owned when they died. Yeah. Okay. So they would say that they would recognize that your estate can't distribute your property because that belongs to your daughter now as a sole owner, but they would still add the value of your half share in the property into your estate for estate calculation. Okay. So £200,000 would be included, which would, eat into your nil rate band, but you your will couldn't distribute that property to somebody else, but the value would be included for inheritance tax purposes.
Okay, so it's just the paperwork.
Yes.
Sorry, I just have a question about debt. Does the same apply to if your spouse dies and has debt? Does the surviving partner have to pay that debt?
It depends on how the debt is owned. Okay, so if the normal principle is that the debts would die with the deceased if their estate didn't have the funds within it to pay. Okay, so that would be an insolvent estate. But it depends on how the debt's owned. If it's a debt that's in the sole name of the deceased and there aren't funds within the assets that they own to pay it off, then the creditors lose out. If it's a joint debt, so let's say it's a mortgage and the mortgage is in joint names, then it means that the mortgage now has to be paid by the surviving joint what's the word, by whoever signed onto that mortgage as well. Okay, so it depends on how it's owned. If there's debts where it's just in the name of the deceased, they'll die with them. If there are loans, let's say, because it's normally loans and things like that, if it's a joint loan, then the survivor, the second loan, my mind's gone back, the second person who's privy to that loan account will now be responsible for settling the entirety of the loan, if there's not enough funds from the assets of the deceased.
Okay.
Does that make sense?
Yeah, but I guess my follow-on question would be, would there be any benefit of having a will in that instance, or in a situation like that where the person has a lot of debt and you have a number of joint?
I always encourage people to have wills, simply because you don't know how much, you'll never really know what a deceased person, what somebody owns until they pass away. There could be bank accounts in their names, they might have life insurance that isn't written in trust. Case in point, a client of mine, her husband passed away. He was awful with money. Okay, he'd accumulated a lot of debt, 6 figures. However, he also, and they weren't aware of it, he also had life insurance that he was paying for, and he also had pensions. And the life insurances weren't written in trust, which means they form part of the estate, but there was sufficient value in the life insurance to settle all of the liabilities that he had, which nobody was aware of. Now, he died and he didn't make a will, and so the wife has now got the rigmarole of trying to work out, you know, his estate and everything else. But if he had made a will, things would just be a lot easier. So you never know, even though you think you know, you just never know. And it makes it so much easier because there's an executor who's appointed. The process, honestly, is for the cost of making a will, it's always worth having a will, in my point of view. Okay,
so the life insurance should go into a trust.
If you need to speak to a financial advisor, so let me just qualify that I'm not a financial advisor, but there are options for life insurances to go in trust. And generally it just means that rather than, if something happens to you, the value of the life insurance proceeds forming part of the estate, if you write them in trust, you name who the beneficiaries are and who the trustee is. And because somebody's been named, that money can go to them almost directly via the trustees, and then it's not included in the estate for inheritance tax purposes. So if there is debt, let's say, for instance, this individual has debt and has also got life insurance. If they say the beneficiary of that life insurance is the spouse will receive that money and it won't go into the estate to then clear off the debt, okay? Because it doesn't belong to the estate, it belongs to the wife, so to speak. Yeah.
Got it. Okay, thank you.
That's okay, but I would still encourage making a will along with the life.
Yeah, I'll be contacting you. Okay. Definitely, Rachel. Yeah, thank you.
So sorry, Rachel. So on that note, say you have like stocks and shares, then are you supposed to list in your will? Would you list everything that you have?
So the reason I ask for people to have an idea of the value of the estate is just so I can give you a picture of inheritance tax, how it works, how it applies to you, and what you can do to better utilize allowances and exemptions that may exist. One, you don't need to list them in the will because your assets and your asset classes will normally change during your lifetime, number one, okay? Yeah. So what you have at the time that you make a will might be different from what you have when you pass away, number two, okay? You would only need to include them if you were going to include them as specific legacies. So if you have ISAs, you might say that the shares that I hold in my ISA, I want these to go to my nephew, my daughter, my son, okay? But if you don't want it to go to your spouse or your child, and that's who's named as the beneficiaries under your will, you wouldn't need to specifically include that as a gift, okay?
Okay. Right, thank you.
Just to be clear, you're saying that, is it that all that dies with the person, or just certain categories of death will die?
So it will only die with the person if there are insufficient funds within the estate of the deceased to pay them, okay? So when I was talking initially, and I think at the beginning, I was talking about inheritance tax, and I was explaining how it worked. I said it's applied to the net estate of the deceased. So what the executor does is gather in all of the assets and find out how much they're worth, and they also need to find out what creditors exist on that estate for the deceased as well. And if there are any assets within the estate, they first need to go to pay off, creditors, funeral expenses, etc. So before beneficiaries receive anything, all liabilities must be settled first. Now, if there are insufficient funds within the estate, so let's say an individual is worth £30,000, but he's got liabilities of £100,000, then there are insufficient assets within his estate to settle those liabilities. And that's when the debts could die with the deceased. But it will depend on whether those debts are in the name of just the deceased. If there were joint debts with somebody else, so if there's a joint loan or whatever it may be, the surviving party to the loan will now be responsible for paying those debts, okay? If the debts are just in the name of the deceased and there are insufficient funds within the estate, then the estate is insolvent and they will die with the deceased. So that's the difference. If there are funds in the estate, so let's say this individual has debts of £100,000, but the value of his assets are £500,000, well then that £500,000 will be used to clear those liabilities, and it will bring the net estate down to £400,000, okay? And so the debts do get paid, and now the beneficiaries will get what remains after the debts have been paid and after inheritance tax has been taken into consideration as well, okay?
Okay. Thanks. Not to be pedantic though, is it possible for you to go to that slide where you did the calculations?
Which one?
Yeah, this one. This 240, I was trying to follow and look at the calculations. Is that the correct figure?
Let me check. Apologies if I'm off, hold on.
Because I wasn't, I'm trying to make sure that I understand how it's calculated.
What I was trying to do, so if it's not right, do let me know, but what I was trying to show is whatever the percentage, whatever 65,000 pounds is as a percentage against £250,000, okay? So don't even worry about the 240,000. The point I'm making is that 74% is available of the nil rate band from the first spouse, okay?
Oh. Okay.
Yeah, so, okay, so apologies if that's not right. The main thing to take from there is when the second spouse passes away at today's figures, I'll get what I've done there. When the second spouse passes away at today's figures, they will have their nil rate band of £325,000 plus 74% of £325,000, which is 240. So yeah, you've got me.
Yes, because in the example 2, at the second bullet point, I think what you did
I put in the figure, yeah, I see.
Yes, right. So now follow. Good. Sorry about that.
No, thank you for letting me know. Sorry. So I should have been clearer. It's another £245,000 on today's figures, but it's not £245,000 of the previous nil rate band. But yes.
Yeah. Okay. Fair enough.
I have a question as well.
Okay.
So I thought it was a really good talk, so thank you. I just want to know what is the most tax efficient way, in your opinion, to give to children, say if you have an estate over £500,000, so after the nil rate band and the resident band, say if you would want to do like a lifetime gift.
Okay. All right, there's a couple of things that you can do. All right, so there are exempted gifts. I don't know if we're going to have enough time. So there are exempted gifts, and then there are gifts that you have to survive by over 7 years. So exempted gifts are normally when you give away sums of money above a certain figure, you have to survive those gifts by 7 years in order for them not to be included in your estate. And that was done because people would be on their deathbed, they own property or whatever, they want to sign it over to their children because they're never going to pay tax on it. The government says no, if you want to make a gift to reduce the value of your estate, you have to survive that gift by 7 years, okay? So part of it is inheritance tax planning, whereby you have to Make sure you start reducing the value of your estate, because you're not going to spend it all during your lifetime, okay? But that's normally done for people who are a lot more advanced in age than you sound, to be honest with you, just because we need to make sure you have enough money. Remember, financial security is the key. We need to make sure you have enough money to enjoy your life, your quality of life that you receive, and to live well into retirement, number one, okay? If there's no way you're going to spend all of that money based on what you're worth now and your age, then you want to start reducing the value of your estate by making gifts. And you do that by giving away assets now, or giving away sums of money now, and in the hope and knowledge that you'll survive that gift by 7 years, because when you do, the value of that gift will drop outside of your estate for inheritance tax purposes, okay? You also have what's called exempted gifts, and these are gifts which fall out of your estate immediately. One of the most common ones is what's called the annual exemption, whereby you can give away £3,000 every year to whoever you want, either one person or lots of little gifts over a period of time, and that will drop outside of the value of your estate immediately for inheritance tax purposes. If you haven't given away any gifts in the previous year, you can add that forward into this tax year. So if you didn't give away any gifts last year, up to £3,000, you now have £6,000 that you can give away. And there are a few other gifts like that. So my advice would be to start making gifts. Generally speaking, but I find from a lot of people that will be when they're a lot more advanced in age, like closer to retirement or retirement. So it'd be to start giving away gifts so that you can survive that 7 years, and to start making these annual exemption gifts as well. Because you're saying it's a child, it may very well be a good idea to put that gift into trust, so that the gift you're giving to your child isn't immediately in their name for them to use responsibly or irresponsibly, and because you don't know what they're going to do growing up, whether they're going to be good with money or not. And by putting it into trust and having them as a beneficiary along with other children, somebody else will determine when they receive money, how much they'll receive, and whether they'll receive it at all. And that's useful because it will take into account the tax position of your child, the marital status of your child, the financial position of your child. So they have all these things to consider before making any gifts outrightly to your child. And until that anything is given to your child from the trust, anything within the trust is protected, so that if they were to be financially irresponsible, creditors have no access to the trust, depending on the type of trust it is. If they were to marry and get divorced, the assets within the trust wouldn't be available for division as part of the matrimonial assets being divided on the dissolution of a marriage. So without knowing much, my advice would be, make sure you have enough money for yourself before you start making gifts, because £500,000 is not a lot of money if you're still quite young, and you have to make sure you've got enough funds for retirement. If you are in a position to reduce the value of your estate now, then start thinking initially about exemptive gifts such as the annual exemption, because you can make gifts now up to £3,000 and they'll drop outside of your estate. If you want to do larger sums than £3,000, whether that's property or savings, whatever it may be, you need to survive that gift by 7 years and not have any benefit from that gift either. So if you give property away to your child, they don't buy it from you at market value rates. You give it to them as a gift. You have to, as well as transferring it into their name, move out of the property if you're living there, or pay your child market value rent. And survive that gift essentially by 7 years. If you are dealing with minors, then it would be a good idea to put that asset into trust, because you don't want them to, let's say, reach 18 and come into a large sum of money and perhaps not have the mental, the emotional or financial maturity and responsibility to handle that well. And also it preserves the assets as well. Okay, so generally speaking, my advice would be somewhere around there.
Okay, perfect. Thank you.
Well.